Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TEXHONG International Group Limited Annual Report. TEXHONG International Group Limited is a diversified investment holding company that offers a wide range of businesses and services. At its core, the company manufactures and sells various textile products such as yarns, gray fabrics, non-woven and garment fabrics, dyed clothes and dresses, cotton and cotton blend yarns, greige, dyed and finished woven fabrics, threads, and textile knitting products. In addition to manufacturing, TEXHONG also processes cotton, sells denim fabric and apparel, and trades in various textile products. The company's services extend beyond trading and manufacturing, as it provides cargo transportation by land and sea, as well as other assistant services such as cargo landing over, storage, and management consulting. TEXHONG operates globally, selling its products in multiple regions including the People's Republic of China, Vietnam, North America, Europe, Brazil, Turkey, Bangladesh, Japan, South Korea, and internationally. With a presence in various markets, TEXHONG is well positioned to cater to diverse customer needs and preferences. TEXHONG International Group Limited market capitalization of $6 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that TEXHONG International Group Limited holds a significant advantage in their industry. TEXHONG International Group Limited trades at a lower price-to-earnings ratio of 5 times and a lower price-to-book ratio of 0.48 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment or could it be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.27%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the company's performance across various segments. On the positive side, the yarn segment has shown significant growth in both Asia and the Americas, with increases of plus 7.8% and plus 11.5%, respectively. Additionally, the gray fabric segment has experienced a substantial revenue increase of plus 84.5%. The non-woven fabric segment has also seen a notable rise in revenue, with an increase of plus 49.6%. On the other hand, there are segments that have contributed to the decline in revenue. The garment fabrics segment has witnessed a decline of minus 14.3% in revenue, while knitted garment fabrics have experienced a significant drop of minus 40.4%. Furthermore, the others segment has also seen a substantial decline of minus 38.4% in revenue. These declines highlight areas where the company needs to focus on improvement and growth strategies to mitigate these losses. The financial performance of a company has shown significant improvement over the past year. The net income has experienced a substantial growth of 63.4%, increasing from RMB 595.1 million to RMB 972.2 million. This upward trend is also reflected in the net income change, which shows an increase from RMB 12,863.4 million in 2024 to RMB 3,137.7 million in 2025. The profit margins have also witnessed a notable improvement. The gross profit margin has increased by 1.4 percentage points to 13.8%, indicating a significant rise from the previous year's figure of 12.4%. Although the net profit margin is not explicitly stated, it can be inferred that it has also increased due to the growth in both net income and gross profit margins. The reasons behind these improvements are not explicitly mentioned in the provided text. However, it can be speculated that various factors such as efficient cost management, effective pricing strategies, or enhanced operational efficiency may have contributed to this positive trend. The company's financial performance has shown a significant improvement in recent times. One of the key indicators of this growth is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends on various expenses, resulting in a net inflow of funds. This achievement is a testament to the company's efficient management and effective strategies implemented by its leadership team. The generation of positive operating cash flow enables the company to invest in new projects, pay off debts, and reward shareholders, ultimately contributing to its long-term sustainability and growth prospects. The company's debt level and interest expenses have undergone significant changes over the past year. A closer look at the non-current liabilities reveals that long-term borrowings have decreased by a relatively small amount of RMB 19,008, while other long-term liabilities have increased by RMB 67,728. However, when considering total liabilities, we see a more substantial decrease from RMB 10,833,442 to RMB 9,723,624. In terms of interest expenses, the company has experienced a notable decline. Interest expenses decreased by RMB 108,747, finance costs dropped by RMB 199,728, and net finance costs plummeted by RMB 221,803. These reductions indicate that the company is managing its debt more efficiently or has successfully renegotiated its loan terms to reduce interest payments. Overall, while there are some fluctuations in specific categories of liabilities, the company's total liability level has decreased significantly, and its interest expenses have also seen a substantial decline. The company's performance varied across different segments and regions. On the positive side, Asia and China demonstrated strong revenue growth from external customers, with operating profits also showing a significant increase. The Americas region, along with Southeast Asia, experienced a notable 15.5% rise in revenue to 23.029 billion RMB, accompanied by an operating profit of 1,194 million RMB. However, there were regions and segments that underperformed. The others region saw unspecified losses, while Vietnam within the Southeast Asia region also reported unquantified losses. Furthermore, specific product segments such as gray fabrics in both Southeast Asia and Americas regions and non-woven fabrics in Southeast Asia incurred significant losses. Management's outlook for the company is centered around growth and profitability. The focus will be on expanding product offerings and geographical presence, with a significant emphasis on Asia, which currently accounts for 91.5% of total revenue. In the near future, the company aims to enter a new phase of high-quality growth, prioritizing the production of high-value-added functional products. This shift is expected to drive efficiency and increase profitability. Looking ahead to 2026, management plans to undergo a significant structural reconfiguration, upgrading value and focusing on emerging economies, sustainability, technological innovation, digital transformation, and automation upgrades. The company has made significant changes to its operations through acquisitions and divestitures. Notably, there were no acquisitions mentioned in the extracted summaries. However, the company did engage in several divestitures. One notable divestiture was the disposal of the group's Vietnam factory in November 2023. This move marked a strategic shift for the company as it exited its knitted garment fabrics business in the region. Additionally, the company sold off substantial quantities of yarn and woven garment fabrics, totaling approximately 830,000 tons and 100 million meters respectively. Furthermore, the company also divested 6,000 tons of knitted garment fabrics through this transaction. These divestitures demonstrate the company's efforts to streamline its operations and focus on core business areas. The company has a history of paying dividends to its shareholders. In fact, it has been consistent in doing so over the past 2 years. For the year ended December 31, 2024, the company paid out both a final dividend and an interim dividend, totaling RM 167,140,000. This demonstrates the company's commitment to returning value to its investors through dividends. In addition to paying dividends for the year ended 2024, the company also paid a dividend in 2025, despite initially proposing no dividend payment that year. The proposed final dividend of HKD 0 was not followed through with, and instead, the company paid out RM 83,666,000 as a dividend in 2025. This shows that the company is willing to adjust its dividend payments based on its financial performance and other factors. Overall, the company's history of paying dividends suggests that it values its shareholders and is committed to returning value to them through regular dividend payments. Concerns about inventory buildup and supply chain disruption have been raised in several areas. Inventory levels have increased significantly, with finished goods and work-in-progress inventories rising by plus 50,435 and plus 183,532 respectively in 2024. Raw materials inventory also saw an increase of 18.7% in 2025 compared to the previous year. Supply chain disruptions are another concern, with supply chain financing increasing from RMB 0 to RMB 2,111,445. This is a substantial jump and indicates potential issues with cash flow management. Furthermore, global logistics networks have been severely disrupted due to military operations and geopolitical conflicts, adding to the challenges faced by the company. The disruptions in overseas markets are also noteworthy, with weak consumption and inventory pressure being reported. However, it's worth noting that the company is taking steps to mitigate these issues, including expanding into new regions and increasing production capacity. That concludes the financial summary for TEXHONG International Group Limited. Feel free to comment below, and I will be happy to answer them when possible.